Do you expect more, or was that sell down, do you believe, a little bit overdone?
From our perspective, I think that the very significant decline we've seen now, we're effectively in a bear market, is really driven by momentum and sentiment, and to us doesn't reflect the underlying fundamentals in China. So we've known for a long time that China's growth is going to slow, and we're starting to see evidence of that. And it's not exactly clear yet whether that evidence is, or whether that slowdown is being driven by trade, or whether it's being driven by a desire to deleverage and slow credit growth. So at the moment, there's nothing out of the ordinary in growth, but the falls 20% plus in the share market really tells us that the market's expecting a very hard landing in China. We're not expecting that. From a fundamental point of view, we think China will continue to slow gradually. We think China's authorities will introduce a fair bit of support for the economy as well, and to us that means that we're probably overdone at this stage.
Okay, we did see a surprise miss on that GDP number that we got out at the end of last week. We were just giving you a look at that 6.5% because we were expecting 6%, and these numbers are usually really well flagged to the market, and very rarely do we see a divergence from what the expectation is. How disappointing was that rate on Chinese growth, and do you continue to see us ebbing down towards the 6 level as we progress over 2019, 2020?
I think importantly, the GDP at 6.5 versus a 6.6, it's a slight miss, but underlying that was some fairly weak manufacturing data and some fairly weak industrial production data. So that's what we're watching a little bit more closely. I think without any support from the Chinese government, there's a risk that growth could slow a little bit faster, but our base case, pardon me, our base case is that we'll see some targeted monetary support, and that we'll see some targeted fiscal support, particularly on the infrastructure side. And I think once we see that kick through, once we see credit growth begin to pick up a little bit from where it has been in the most recent 6 months, we'll see growth steady off, and we're expecting something closer to 6.5 to 6.3 over 2019. And that's that gradual slowdown that's been highlighted by the Chinese authorities over the last couple of years. And I think that would be very much in line with our expectations. A deviation down to 6% growth, I think, would be at the low end, and I think that would start to see some further declines in equity markets from here.
Still watching? Perfect. Click here to watch another great video from CNBC International. Oh, and don't forget to subscribe. Thanks for watching.